Well, we just heard the governor and all the deputy governors giving their bit of why the RBI has, or rather the MPC has decided the way it has, and they also tried to explain why the stance has remained neutral. There are some contradictions, but that perhaps is inevitable at a time like this when the signals are quite ambiguous. One really doesn't know which way inflation will pan out, and the Deputy Governor Viral Acharya was honest enough to say that we don't have enough of a fix on what the impact of the MSP hike will be. But actually, I am a little intrigued, speaking for myself, about why the RBI's hike rates, and that to by 25 basis points, given that the inflation projection that they have given for this year is just marginally above what they had given in the June policy statement. Also, the governor in a statement has said, in the press conference has said, that the MPC has opted for 2 rate hikes, one after the other, because they want to bring the inflation number back to where that 4%, that central point of 4%. But if that is so, then clearly their efforts are not succeeding, because the projection for the first quarter of the next fiscal is 5%. So if the 2 consecutive hikes were driven by the need to bring it back to 4%, and inflation, instead of getting back to 4%, moves up from 4.8 to 5%, it really doesn't say very much for monetary policy. But I don't know whether I'm being a little harsh on the MPC, given the fact that it's very, very difficult to really project inflation in a very scientifically correct way. So let me bring in Mr. Praveen Gupta at this point of time and ask him whether he agrees that there are some contradictions in the policy statement, but that is inevitable at a juncture like this. Praveen?
Yeah, but I think, see, one is again, this 1/4% hike was more or less what the market expected, and the RBI has delivered on that. The other way to look at it is that if they are projecting inflation to go to 4.8 in the second half and to 5% in the first quarter of next year, so which means that the hike is warranted. So, I think the point which has been generally made, I think the Anand also made that point earlier, was that it does mean that this could not be the last hike. Probably there could be more hikes coming actually, and that is what the market seems to be anticipating. So, if you look at the 1-year T-bill rates or the 10-year yields actually, so which means that the inflation battle is not probably over at this point of time. So, we will still have to be very careful about how this inflation plays out, and if it does go to 5%, so which means that there could be more hikes going forward actually.
Yeah, indeed. Mr. Gupta, I want you to really highlight as to what is it that you made, the point that Maithili was earlier making, that it didn't seem that this 25 bips hike was much needed, considering the RBI is pretty much sticking by with their inflation target, a little higher perhaps, and growth as well is what they see as normal right now. So why exactly do you think that the RBI moved in the first place?
See, the other way to look at it is, this inflation, the interest rate hike do get transmitted with a lag. I think the point Viral Acharya also made in his intervention today. For the banks also, I think the liquidity has been very good. So, all the past hikes that have happened also have not fully been transmitted. To some extent, transmission has happened on the deposit side, but I think on the lending side, full transmission has not yet happened. So, I guess going forward, as the liquidity does get tightened a little bit, actually the banks may have to increase the rates, in which case the hardening of interest rates happen in the market, and in which case the full transmission happens, and then the impact on the inflation comes. See, ultimately, this is at the end of the day a very blunt instrument. I don't think that it directly impacts the inflation, but as a regulator or as the authority responsible for the monetary policy, they have to make sure that they make use of all the tools that are available actually. So, given the projection which they have come out with today, I don't think they had any option but to hike the rates by 1/4% today.
Mind is going to be the future course of the RBI. They've moved already twice this year. Do you think it will be a status quo for the balance, or do you think much will depend on what really builds on with trade wars, or for that matter even crude?
Yeah, if inflation does play out as they expected today, I think there could be more hikes, and that is what the market already seems to be factoring in the rates. The T-bill rates already are factoring in those hikes coming in the future.
Okay, thanks very much for joining us, all of you, Pradeep Gupta, Abhik Barwa, and of course Nilesh Shah, who continues to be with us, besides Maithili Busnurmat. And Nilesh, I do want to ask you a question. The governor very categorically said that we need to run a tight ship on risks that are under our control, and yet they don't seem to be taking the impact of impending trade wars into cognizance, because if you are going to keep growth levels intact at 7.4% projected levels, are you not taking the impact on exports on that count?
Maybe it's driven by the fact that it's a bit difficult to measure what will be the impact of tariff war. For us, we are not that large component of trade deficit with US. Right now the attention of US is more focused on Chinese and European Union. India is too small a country to focus from a trade war point of view. My guess is that his indication towards the risk was mainly coming from the currency market. RBI has used about $20 billion of reserves to defend rupee. It has an impact on currency value as well as impact on domestic liquidity. In some sense, we need a little bit higher interest rates to defend our currency. In the past, we hardly used to have any limit for FII debt. Today, there is almost 1 lakh crore worth of limit available for FII debt, about 49,000 crore in gilt, 61,000 crore in non-gilt corporate bond. So clearly, some amount of rate hike is also a function to support depreciating currency, which kind of retains debt FII investors' interest and ensures that our reserves remain above $400 billion.
Right. Okay. You know, I have to thank both Pradeep Gupta and also Abhik Barwa, but before I let go each of them, a quick question to you and Mr. Gupta, if I may come to you on the question and of transmission. Viral Acharya very categorically said that the transmission is with a lag. Now there are two back-to-back policy hikes that have happened in a space of just about 2 odd months. By when do we see this having an impact on lending rates? By when do we see transmission actually happen? Mr. Gupta, Praveen Kumar Gupta.
But I think the transmission again has been a factor of liquidity in the market also. The liquidity has been good. I think liquidity has just gone into the neutral mode. On some days we are seeing liquidity a little bit negative also. The credit growth is almost at 13%, but on the deposit side, I think we are growing at around 8%. So going forward, we do expect, the liquidity will become a little bit tight. At this point, the banks are sitting on excess SLR. The LCR ratio, which is expected to be maintained at 90% as of now, I think the system as a whole is still in excess of 120 to 130%. So there is a liquidity available with the banks which can probably be used. But I think that, come September, October, we could see liquidity tightening a little bit, and that is the time when, the full transmission will happen. The banks have already increased the deposit rates to an extent. The MCLRs also have gone up. Actually, if you have been monitoring for the last few months, I think, the banks have been fixing these MCLRs based on their deposit rates every month. So the transmission has been happening in, triplets, 5 or 10 basis points a month. So because we don't change the rates in, like one go, and because it is happening every month in small little pieces, so probably doesn't get noticed, but to some extent transmission is happening, but the rest of it will happen depending upon how the liquidity plays out actually.
Fair point indeed. I know you have to go, so thanks very much for being with us, but I know Abhik Barwa also has to leave. But Abhik, I have to ask you this question. There was so much being said about core inflation before the policy began. At levels at 6.3%, core inflation was bound to be a concern. Yes, the food inflation has been soft and that has been some respite, but core at 6.28 or 6.3% was bound to be a concern. Does the argument and the statement from the governor that core is not a problem, the legislative target is to manage CPI at 4%, does that argument cut ice with you, Abhik Barwa?
Well, I think they just toggle between these two things when they need to justify their policy action. In the last policy, there was considerable emphasis on core inflation as a major, if not dominant, concern. But you know, at this time they're saying that it's really the headline inflation that is the mandated level, and that what they should be addressed. My personal view is, you know, there are two things that are driving this policy. One, and I think these are very, very major changes that are happening. One is from the kind of, you know, backward-looking data dependency that characterized policy, you know, in some of the previous policies. We are now moving to a very, very forward-looking, you know, policy domain. And in this forward-looking policy domain, there are two facets. One is transmission to actual lending rates, and then the transmission of actual lending rates to the real economy, which would sort of harness inflation. So we are taking a very, you know, the RBI is taking a very long view on the operation of the policy rate, A, on lending rates, and B, through lending rates on the economy. And the other thing that I'd like to emphasize before I leave off is something that, you know, Nilesh you know, flagged off, that although, you know, because of various reasons, the RBI does not want to bring in an explicit discussion on currency defense, and it just goes by this fiction that it only, you know, irons out volatility. I think the RBI is very keen to prevent depreciation beyond a point, and it is implicitly defending a level, and a rate hike is straight out of, you know, the copybook in order to defend a currency against excessive depreciation. So I think we have a lot of answers in what the RBI said today. I think the core inflation issue is you know, perhaps still a little confusing, but I think that there are other, you know, compelling factors which drove the RBI to do this, and it actually signals a fairly major change or recognition of a change in the way policy is conducted.
No, absolutely. You know, there's 6 minutes to market closing. Let's close markets and come back and discuss a lot of what was said. You know, is this also an attempt to, like Abhik Barwa said, not just, you know, defend currency against constant depreciation, but is this also an attempt to perhaps tamper the froth in capital markets and all of that? We come and discuss that in a moment from now. But I've got Maithili Bruce Nurmat right here with us. I've got Jaideep Parrier, Head Strategy at RBL. I've got Upasana Bharadwaj from Kotak, and of course Nilesh Shah continues to be with us, MD Koti at KMC. So thanks each one of you for being with us, and let's actually start from the policy action before we move any further. Two consecutive back-to-back hikes of 25 basis points each, and yet the stance continues to be neutral. There's not one, not two, not three risks that have been highlighted to inflation, but about 8 odd risks that this policy really highlights. Maithili, I'm going to come to you. Ironical that the stance is neutral, and yet we're seeing two back-to-back policy rate hikes?
Well, not really, because there was this inconsistency last time round too also, and I think maybe the MPC's fear is that if they had, you know, also had a hawkish stance, that along with the rate action, that might send the very wrong signal. It might be a case of overkill, because as Viral Acharya was honest to admit, one really doesn't have a fix on inflation as yet. In fact, I am a little puzzled, because to me there seems to be some inconsistency in the policy statement itself, because given the fact that you've hiked the rates and you've pointed to all the reasons why inflation is going to look up, including the fact that the output gap has almost closed, then I'm a little surprised that your inflation numbers are not much higher than what they are. In fact, for this fiscal year, the inflation number is just marginally higher. Perhaps that shows the perils of, you know, trying to put something like inflation, which in India is, you know, fairly driven by supply side factors as well, to try to put it into an equation and get a pat answer. So I think the RBI has played cautiously. So even though there does seem to be this internal inconsistency in that this year's inflation number is not very much higher, in fact it's barely marginally higher than what they had in June, the RBI still preferred to hike the rates even though the estimates have not moved up so much. So I think because there was a slight inconsistency, really they prefer to play it safe and not change the stance. There always is that option, of course, to do that in October, depending on what the Fed does in September. So as of now, yes, there are some inconsistencies, but I was broadly in favor of a hike. So to that extent, I think the RBI has played it right.
Okay, so the RBI has played it right as far as the hike is concerned. It's the extent of the inflation projection being revised upwards that's many people are questioning. Before I go across to Upasna, I'm going to go quickly across to go across to Nilesh. I'm going to go across to Upasna Bharadwaj. And Upasna, do you believe this is inconsistent? I mean, look at the commentary. The commentary seems to be raising a lot of concern on inflation projections and inflation outlook. About 8 odd reasons have been highlighted, from crude that is volatile and vulnerable to global financial markets, household inflation expectations, input prices hardening, monsoon distribution, fiscal slippage, full impact of MSP, HRA revision, and yet the second half inflation projection has been revised up from 4.7 to just 4.8%. Is there a little bit of an inconsistency there? I mean, if there were these grave concerns on the upside, shouldn't the numbers have gone up far more?
No, I think, Supriya, what we need to really read these statements is very carefully, that RBI has very well balanced each of these statements, saying that there's an uncertainty which could actually flip on either of the two sides. When RBI is talking about oil prices, they say that there is a possibility of oil prices going higher or lower. Again, on the MSP side, they do not know how exactly is going to be the pass-through, or what is exactly going to be the impact. On the fiscal side, they have definitely warned about the ramifications of fiscal slippage, but they are yet not, there's no such a surety of a fiscal slippage. So each of these parameters are supported with a downside risk as well. So that is one of the reasons why I would say there's no inconsistency, because they maintained a neutral stance given the uncertainty to each of these factors. At the same time, there was an upside risk to the inflation in the previous policy, in the June policy, which now is kind of evenly balanced again because of the uncertainties which could sway anywhere. In part, probably RBI has incorporated the MSP impact, and hence there is a slight upward revision. But beyond that, there is a possibility that if any of these risks that RBI has highlighted, they materialize, then we will see a significant upward revision. But as of now, there is an equal amount of chance that we may have to see a downward revision, because each of these parameters could actually err on the other side as well, and hence RBI would have chosen to tread this path, the middle path, which is a little more balanced, I would say. So hence no consistency I see in this document.
Okay. Okay, so you don't see any inconsistency, you believe this is a consistent thing. But Nilesh, I still have to ask you the question, enough has been written and said about core inflation, and that was a big concern before the policy. At 6.3%, that is excluding of food and fuel, core inflation doesn't present a very pretty picture. It has been going up consistently, about half a percentage point every quarter, and yet the RBI in its statement, and of course in a consequent question that was put forward to the governor, very categorically says that core is not really our problem. Legislatively, we have to target CPI, the headline inflation, at 4%. Is there, is there some sort of a distance between what they are saying and what they actually want to achieve? I mean, core inflation at 6.3%, how can that not be a concern for the RBI?
I think this is a structural issue. While mandating RBI to manage inflation, we focused on headline inflation rather than developed market practice of core inflation. Clearly, the food prices are more determined by supply side pressure. Fuel prices are driven by global factors. But for a variety of reasons, the government probably thought it appropriate to push headline inflation for inflation targeting. And I'm sure over a period of time there will be debate about this, and at some point of time, like developed market, we will have mandate to manage core inflation. But this also raises another point: are we calculating our inflation correctly? Clearly, RBI has been stripping out HRA impact of state pay commissions, because in some sense there is circular reference between HRA allowances of government employees, which gets as a proxy for housing inflation. So we need to continuously improve our inflation measurement, and at some point of time align our practice of targeting inflation with core inflation rather than headline inflation. But till such time that happens, RBI has no option but to go and do the job as has been legislated to them.
Okay, fair point indeed. Till such time they will have to do this job. But let me take this across to Ashish Vaidya, MD and Head Trading and M&M Treasury Markets, DBS Bank. And Ashish, many people were expecting the RBI to make a statement on the rupee, on the kind of depreciation that we are seeing. For all practical purposes, it does not, and we all understand why did the RBI not talk so explicitly on the currency. But in many ways, has the RBI through this rate hike also defended depreciation of the rupee? Was that one of the big motives of this rate hike? Apart from inflation, of course.
Yeah, so coming to your first point, that people were expecting, the RBI to make some statement on the rupee. I think traditionally, historically, they have never done that, and they will never. They have not done that till now, and I don't think we really expected that to happen. But yes, clearly, a higher rate in the shorter term will keep real interest rates slightly higher, so it is beneficial for the currency. Though it's not really a game changer, but yes, it's a slight positive for the currency.
Ashish, just hold your thoughts there. I've got SK Ghosh, Soumyakanti Ghosh of SBI also with us now. And Soumya, since you're joining us late, I'll take 2 or 3 back-to-back questions with you. The first question is a question that Nilesh Shah did address a while back, but I'll still take it up with you because you put forward a report on core inflation. I mean, one doesn't know what are the factors in core inflation that is really driving inflation up at 6.3%. And here you have the RBI that says, you know what, core inflation is not our concern, CPI is our concern. How are you going to read those 2 statements? Because core has continued to be very, very stubborn.
I think I think one of the arguments which was given by the RBI governor post the press conference was that core is actually one of the components of the CPI. So therefore, any increase in the core could actually push up CPI over a point of time. And there is also a perception that the core CPI and the CPI ultimately converges at some point of time. So if the core CPI actually is going up, it could be a possibility. I am just saying this is a possibility or a hypothesis is that the CPI could also move at some point of time. So that is the one. That is one of the reasons why we can reconcile the argument that why the rates have been hiked even though the core CPI is rising and the CPI is actually remains at 5% level. However, the larger picture is that I think the rate hike in June which when happened, I think was to try to move ahead of the curve, and the rate hike now is also basically, as you know, after the June rate hike there has been a 3% rupee depreciation, and I think possibly that had actually set the course for possibly a rate hike in August, and this rate hike came through. So because once a rate hike happens in a market when a currency is depreciating, that actually becomes a self-fulfilling prophecy in the markets, and the market expect more rate hikes. So therefore, today also the market is possibly expecting even one more rate hike during the course of the entire year. But I think the good thing is that possibly we are through with the rate hike cycle, at least for this year, because the numbers which are going to come after this specifically from August onwards will actually show a steep deceleration in the headline inflation and also the core inflation. So that's why the governor was very particular when he clearly said in the press conference that the CPI prints will be volatile in the next few months, and that's why we have kept a neutral stance and all options open on the table. So the RBI is also clearly cognizant of the fact that even though the rates have been hiked, there is a possibility that the CPI numbers, including the core inflation, which also we believe could actually surprise on the downside in the next couple of months. That is excluding the base effect which we all of you are talking about.
Okay, fair point indeed. But Soumya, I have to ask you another question on growth. Growth levels are kept intact at 7.4%, and yet the RBI commentary and the governor also mentioned talks about global trade wars. Yes, we may not be China for the US, we're still a very, very small player, but we cannot be mute spectators to what's going to happen in the world. It will eventually impact us. So for the governor to say we will run a tight ship on risks that we can control, is he not taking into cognizance the impact that these trade wars will have eventually on India's exports? And how can growth be at 7.4% if export levels are going to be compromised?
No, I agree with your point. I think growth at 7.4% looks a little bit challenging to me at this point of time, because for all the good things, I don't see India going, the export growth rate is going to be very strong this year. Already we are in a cycle where we are seeing asymmetric global growth across countries. Eurozone is an example, and the anecdotal evidence shows, and there is now a consensus which is actually building up throughout the world, that possibly we are towards the end of this synchronous growth cycle, and maybe 2019 end or 2020 could be a period when global growth will start to decelerate. So, given the fact that we have a limited window of the global growth going strong, I believe that the Indian exports are unlikely to gain significantly in the current year, and that is going to be act as a dampener on our exports. And also the fact that the trade war, initially we thought that it was a bilateral trade war, but right now we are seeing that it could actually extend to a multilateral war, and it could be even a full blown, because the US has been talking about 34 billion Chinese exports, then 200 billion, now they are talking about 500 billion. So, taking all these factors into account, my sense is that trade war and also the domestic demand condition has somehow slowed down in the last 1 or 2 months. So, I think 7.4% growth rate may be a little bit on the higher side as of now.
But I still have a question on growth, and before I go across to Jaideep Iyer, head strategy at RBL, I'll take a quick question to Nilesh Shah. And Nilesh, the RBI commentary and also this assessment that has been given to us categorically states that output gap is narrowing, capacity utilization is rising, we will see perhaps demand go up. In fact, I think the survey of the manufacturing companies has also shown input prices hardening and all of that. What does all of this mean for economic activity put together and for growth eventually? Nilesh?
So far all the results which we have received this quarter, it clearly shows volume expansion, margin expansion in certain counters. The output gap might be narrowing down more in consumption related sectors like automobiles, FMCG, consumer durables and so on and so forth. But this we are not seeing reflected into order book for capital goods intermediaries. The capital goods companies are still not showing order growth. One of the largest capital goods company had order book growth of just 3% year on year. So clearly there is something which is restricting investments by entrepreneurs. It could be ease of doing business, it could be high real interest rates, it could be dumping by China, it could be election, but there is something which is restricting investment activity at private sector level despite capacity utilization inching up and output gap narrowing.
Yeah, that's a fair point indeed, and I think that is what is actually restricting economic activity, because no amount of smooth talking, no amount of the Prime Minister saying I stand with industry, I'm not ashamed with the industry, is actually making them put where the money really counts, is really making them put where the money is, and I don't know if capacity utilization is really the answer to some of those woes. But let me take this across to Jaideep Iyer, and Jaideep, one wonders if today's decision by the MPC also considered the froth in capital markets. That's question number one. And question number two is 2 back-to-back hikes of 25 basis points. And my larger sense is obviously they will be data dependent going forward. But how many more hikes do you expect in this calendar year, in fact this financial year?
So I think the 2 rate hikes that we've seen was largely in line with market expectations. I think the swap market and the bond market had already factored in these rate hikes. Based on what we are seeing from a markets debt markets perspective, we could probably see one more rate hike in the fiscal. I think from an RBI perspective, obviously they are seeing Indian economic corporate performance improving, capacity utilizations improving, and at the same time I think uncertainties around the global markets and the global economy increasing, and I think and therefore I guess looking at these 2 factors, the decision to kind of take a hike and keep options open going forward was probably the right thing to do. In fact, from a market standpoint, I would imagine that it is better for markets if the policy has been kept. I mean, policy hike happened and the stance has been neutral, rather than having a hawkish, uncertain, immediate future in terms of rate hikes and not doing an actual rate hike this time. So I guess all in all, I think it's a good outcome in that sense from a market standpoint as well.
Nilesh, can I put you on the, can I put you in the dock and ask you a little tough question? This is obviously not hawkish with the pause. This is not dovish with a hike, because too many things have been explained of what are the risks to inflation. What would you call this policy eventually?
I will duck that answer, but I just want to raise one additional point about the government's borrowing program in second half. This will be the second half where festival season demand will pick up. Second, this will be the season where your liquidity will be tight because of the festival season. The supply pressure with or without fiscal slippage will also emerge, because in first half this time the borrowing has been at a little lower pace. And most importantly, there will be election related uncertainty. So apart from all the economic factors, the pure demand supply equation of gilt also will have an impact onto the market yields level, and that's something which one will have to manage very, very carefully.
Yeah, fair point indeed. But on that note, Nilesh Shah, Shaumikanti Ghosh, Upasana Bharadwaj, Jaideep Iyer, of course, Ashish, just stay with us. And of course, Maithili Busnur, just stay with us for a minute. We'll take a really quick breather and we are back. We're going to discuss a lot more of what the RBI said and much more that was left unsaid. ICICI Bank, once again a question brought up, and the regulator says, I can't comment on a specific bank. I mean, you're the regulator of the banking space last third, but let's take a quick breather, come back and track all of that in a more refined way. Good to be back with you. We're tracking the RBI policy right here on ET Now. It's a consecutive decision to hike the policy rate by 25 basis points. The stance continues to be neutral. I've got Jaideep Iyer, Head Strategy at RBL Bank, Ashish Vaidya, MD and Head Trading, Treasury and Money Markets, of course, Treasury at DBS. I've got Maithili Busnur, our Consulting Editor, SK Ghosh, Group Chief Economic Advisor, RBI, amongst others. Ashish, if I may start this round with you. The Deputy Governor Viral Acharya was very categorical when he said that the monetary policy transmission happens with a lag. How soon do we expect this transmission to happen? Because we've already got two policies behind us, two policy rate hikes behind us.
Yeah, so I think what we have historically seen is broadly the lag is almost about 6 to 9 months. But yeah, so I think the point probably what he was trying to make, if I can make that assessment, is that that for now we are done with some rate hikes. The external environment and the internal environment going forward is fairly volatile. We do expect growth to taper off as because certain headwinds are there in the global economy as well as locally. So that's the reason I think they are trying to take a very sort of a balanced stand, not really speaking out exactly how inflation or oil price or the Fed policy or rest of the world macroeconomic policy is going to pan out. I think in that context probably he was mentioning that there is a lag, and maybe also importantly one can take an indication that two back-to-back rate hikes, if nothing really changes in a dramatic way as far as the Indian macro is concerned, then I think we are at a stable we are on a stable ground, and that's the reason primarily to keep the policy stance as neutral. So I think it's a sort of a reality check in a way, because we are in a volatile environment and we really don't know which way the things are going to shape up.
No, you're absolutely right. We are in a volatile environment and the RBI is not willing to take any chances. SK, a bit of a tricky space there to answer, but fiscal slippage seems to be very much on RBI's mind. It's one of the 8 factors highlighted as risk to inflation, and it almost seems to suggest here that the RBI is wary of the government's actions, at least on the fiscal front. At least in an election year, it does not want the government to go berserk. Is this a checking tool, a checking mechanism as well? Shaumikanti Ghosh, that question is for you. SK Ghosh?
Yeah, I can now hear you. I think that, yeah, I can hear you now. The voice actually, we lost the line. No, whatever I understood from the question which you asked me about the fiscal slippage, I think yes, the fiscal deficit this year is going to be a little bit challenging. We already have some of the measures which have been announced. Sugarcane, for example, is one of them. GST collections are still, today's number shows that it is trending at just below 1 lakh crores, and there has also been a lot of concession which has been given in GST in the last July. So expect that GST numbers could actually go bit and go down a little bit and then recover. So there is a threat of an fiscal slippage this year. It's very difficult to say as of now because we are only in the 4th month, but there will be pressures on the government to actually cut down expenditures so as to get to the 3.3% deficit. So that, and of also the fact that there will be some more maybe measures on the agricultural front in terms of an income support package as the Kharif session nears. So taking all these factors into consideration, I think there will be a challenge on the fiscal front, and it remains to be seen how the government cuts its expenditure or looks at its priorities so that the growth is also not hampered in their decision making.
Oh, that's a valid point, that this will be a concern on the fiscal front. Maithili, I know you're not a fiscal hawk, but in an election year, is this RBI's way of telling the government to not exceed the borrowing target because things are volatile as is? And a higher fiscal deficit doesn't augur well for an economy. Is this also a function of the fact, like SK was pointing out there, that GST collections have not crossed the 1 lakh crore mark except for once in the last 1 year? The asking rate is 1.1 lakh crore. It's varied between 85 to 94,000 crore. In that sense, does revenue obviously continue to be a concern as a corollary? Is fiscal deficit also a point of concern here right now? Deficit also a point of concern here right now?
Well, revenue was always a cause of concern, particularly after July. We've seen the rate cuts that were allowed in the GST at the last GST Council meet. So clearly revenues are going to take a hit. As far as fiscal consideration are concerned, I don't think any government cares about what the central bank says when you have elections staring you in the face. Your one and only objective is to get re-elected, and the fiscal deficit can really kind of take a backseat or kind of disappear altogether. But central banks have to do their job, so they will keep talking about fiscal deficit. Central bank and the Reserve and the government will just pay little or no heed to it. But I want to come back, Supriya, to a question that you asked both Nilesh and Soumya on the core inflation. And here, in fact, I'm very happy to see the shift in the RBI stance from saying that, look, instead of talking about core inflation, we need to look at headline, for the simple reason that in the Indian context, core inflation accounts for barely 30% of the consumption basket, in contrast to the US, where core accounts for 80% of the consumption basket. Add to the fact that 70% of the population is in the rural areas, for whom it is the non-core part, that is food and fuel, which matter far more. It's only right that I think both the mandate to the MPC as well as the new direction given by the MPC of focusing on headline rather than core, I think is entirely appropriate. It was something that they needed to have done in the past as well, and they've done it now, so I'm very happy. And just one more small point, I find it a little ironic that whenever the RBI is hiking rates, they talk about monetary transmission and it takes such a long time, so we have to do it much in advance. Entirely well taken. But when the RBI cut rates, it expects this to happen immediately. Then there is no question of poor monetary transmission. Today you cut and tomorrow you ask the banks, why haven't you cut? So I think this is another inconsistency that I like to point out in the RBI, not just this particular RBI, but every governor of the RBI expects that when they cut, transmission should be instantaneous. When they hike, oh yes, of course there's a lag.
Oh yes, That's a very valid point, and trust Maithili to point that out. That was a point that I was thinking of asking and then dissuaded. But Jaideep Iyer, since that point has been raised on a lag as far as hike is concerned and an instantaneous result if a cut is concerned, how are we going to reconcile to the two voices by the same regulatory authority? So that's question number one. And question number two also is that you know, the MPC has very categorically said that one doesn't still know the impact of MSP, and it will all depend on the extent, the kind of crops, in Kharif it will be extended to, the kind of procurement that will be done. It's all going to be dependent on that. So where does the impact of MSP on inflation lie? Does it lie from a 20 to 30 basis points, or could the range actually be, say, an impact of 70 to 80 basis points?
So let me first address the transmission question. I think when RBI is on a cutting mode, I think there is a lot of political drama around it as well, because it is under a lot of demand by the government and the industry to cut rates. And when RBI cuts rate, it expects the banking system to transmit it rather quickly. But naturally that doesn't happen, and fortunately this is a proof where banking sector also on the way up will do it with a lag, and that's very clearly seen in the bond market or in the corporate bond market, where today corporate bond yields for, let's say, a AA rated corporate would be far more expensive than the loans that they are able to borrow from the banking system. So clearly that is because while you know, banks do have the benefit of average increase in their cost of borrowings, because the impact of a policy change or an impact on liquidity is really restricted to the incremental deposits and borrowings that banks do, whereas they are guided from a lending standpoint more on the average cost of borrowings. Also, typically the banking sector doesn't like to be very volatile about its lending and deposit rates, because the decisions are more taken with a 6 months, 9 months, 12 months kind of time frame. So I think it is it's an interesting thing that's been pointed out in this context, that you know, that should be remembered when we have the next rate cycle and the banks don't get hounded for rate cuts. On the MSP, I think there will be a lot of uncertainty around which crops and how you know, what kind of quantums really get transmitted into inflation. And I don't think it is in the 70-80 basis points range at all. I think it will be more in the you know, 10 to 30 basis points range, and some of that is already being factored in by the Reserve Bank in its inflation projections. And therefore I think the margin difference here may not be substantial. And I think, you know, that is also one of the uncertainties that they have quoted in wanting to keep their options open in terms of how they move over the next 6 to 9 months.
Okay, fair point indeed. Let me go across to Shaumyakanti Ghosh. And Shaumya, so two questions. Do you agree with Jaideep that this impact of MSP will be in the range of 10, 20, 30 basis points and not higher? How challenging, A, will it be to figure out what the impact will be? And B, I do want to talk a little bit about liquidity. You know, liquidity is now perhaps moving into the neutral zone, but will we see far more tightening come the festive period as demand goes up? Shaumya?
Hello. Yeah, I lost your voice again in between, but I can understand two questions you asked me. The first is basically regarding the MSP impact. Yeah, can you hear me now? Yeah,
Yes.
the MSP impact. Yeah, can you hear me now? Hello?
Yes,
Yeah,
yes,
can
go
you hear
ahead.
me? अरे ये क्या है?
I can, go ahead, Shaumya.
Yeah,
I
the
can.
MSP impact, I don't think it will be in the the MSP impact will not be in the range of 7. In fact, we had also estimated the 73 basis point, but that was purely on the basis of procurement. I don't see in the impact of the MSP should be as large this year, because there are a couple of factors which is playing against it, and unlike last year, global food prices continues to remain low. The procurement, there is a limited ability of the government to procure the crop, and also there has been no pay commission recommendation which happened in 2008-10 when the procurement prices actually went up, and in fact the rural wage growth also continues to remain muted. So it is very unlikely that this MSP will have a significant impact on the inflation. Maybe it could be around 20-25 basis points at most. Regarding the question on liquidity, I think the liquidity, the central bank could have spelled out its stance, because as we are, as the numbers suggest current now, I think the RBI needs to do significant amount of liquidity injections in the current year. Our numbers suggest that these numbers could be even higher than 1.5 trillion, because the way the currency withdrawal has been going, the deposits have been growing, and even the other things like the government cash balance spending has been growing. So in all sense, my sense is that the liquidity continues to remain a little bit problem for the system as such, and how long the banks are going to transmit from this 50 basis point rate hike will depend crucially on the amount of liquidity in the system. If the liquidity continues to be in the deficit mode, or in the neutral, or at most in the neutral mode, the banks will find it not easy to stop passing on the rate hike or the transmission. So it's a function of the liquidity, and hopefully the central bank has taken cognizance of the fact, and he has done 2 OMO in the every month, and maybe the pace of OMO needs to go up significantly in the second half, so that the liquidity remains in check. The liquidity deficit remains in check.
Okay, fair point. Ashish, I want you to comment on liquidity, and some of the things that Shauna said makes sense, that liquidity deficit will be a will be a thing of the past going forward. But I also wanted to answer the question, September decision by US Fed, and this is a big week for global central banks. The September decision of US Fed, how much is that going to determine what the MPC does when they meet between the 3rd to the 5th of October?
Yes, sorry, I didn't get your first question because I think the voice was breaking. I didn't get the first part of the question because the voice was breaking.
Go ahead, you can take the question that you got. Answer the question that I really asked.
All right, so basically on the September right. So basically, on the action for US Fed, I think that in any case is a question of time. It seems to be on course. The data on the US is fairly positive. The US is, the macro data is quite good. So US is on course for that. I don't think that's really going to weigh too much on the MPC side. Yes, that is one of the considerations, but that's not the sole consideration. The important thing is what's happening in rest of Europe, Japan, elsewhere in the developed worlds, how exactly oil is going to behave, and how exactly the US Treasury and dollar strength is actually panning out. So if there's a case for a significant dollar strength, and India continues to face some sort of headwinds in terms of oil prices continue to be high because the US growth is fairly strong, I think in that case, the macros will get revisited, and then eventually the MPC will have to take a call. But given the current situation, the current stance, and given the current the environment, which is in terms of whether oil has also backed off from 80 to 74, 75, the backwardations are fairly small. They're not really as large as it used to be in oil. And overall, the US commentary is also coming in terms of 3% or 3.2 kind of levels is going to be toppish. There's a clear concern globally in terms of growth going ahead. So in that situation, I think so the MPC will have to look at those variables. But I think the growth concerns will start to hit the world probably in the second half of the calendar and maybe towards the early 2019. and I think that could provide a shift and a pause kind of outlook, and that's what exactly I think the RBI is also trying to communicate, that things are fairly volatile. Just wait and watch. Not ready to take any hard calls on any direction.
Fair point. Just hold that thought, because I've got a special guest. Shyam Srinivasan of Federal Bank is joining us right here, and thanks very much, Mr. Srinivasan, for being with us. The second hike in a second consecutive hike by the RBI along expected lines. Question number one, and are you surprised that the stance continues to be neutral? Because the RBI has justified risks and also justified why there is an upside and a downside to that. So quick questions there. A, are you surprised with the consecutive hike, or did you see it coming? And B, are you surprised with the stance remaining neutral despite the fact that there have been two consecutive hikes now?
I think being surprised, Supriya, as you know, most of the polls had pointed out it's a close call. So I don't think it was a very sort of done and dusted thing. But having seen the sort of rate hike, the one takeaway is it seems to be more decisive, because there is this sense that the headline inflation may remain elevated over a period of time. In that context, probably it's a decision taken to sort of upfront a few actions that are required. To my mind, for the calendar year, this may be the only rate hike. And given the fact that they expect next year's print to be about 5%, so I would think this is probably a decisive action. But I can't say it was a done deal. Most the calls were quite close, and so it was not very clear that there would be a rate hike. The fact that it's a neutral stance is good, in the sense that there is scope for it to move both ways, since everything, all the data that we picked up points to the fact that the risks are equally weighted, whether it's oil or the trade related risks. So I would think that the fact that the rate hike has been announced, after looking at all the data presented, seems like probably the right thing to do. Was it expected? I would think it was kind of mixed.
No, it was always going to be a close call, and yes, you're right. I think polls after polls were divided upon a rate hike that was coming and a pause that was going to be maintained. But Mr. Srinivasan, there are 8 big pointers that the RBI has outlined in terms of the risks that exist to inflation. So it's oil that continues to be volatile and vulnerable, it's volatility in global financial markets, the household inflation expectation that has gone up significantly, input prices that are hardening, monsoon distribution, fiscal slippage both for the centre and the state, the full impact of MSP, one which is not known right now, and the HRA revision by the state government. The RBI, of course, has given these risks, and it has also highlighted both the upside and the downside of some of these risks. But if you read these risks to inflation cumulatively, where do you see inflation settle? Because despite all these risks, what the RBI has done is it has taken up inflation projection by just a very minor notch, from 4.7 to 4.8 for the second half of this fiscal. How do you see inflation play out, given the kind of risk that I've just read out to you from the RBI?
No, I think that's why I pointed out they are talking of FY20 inflation rates early calendar 19 to be about 5%. So I am of the view that this rate hike is probably upfronting or preloading what could potentially happen going into the calendar 19. So in some sense, the risks that you read out are it's not certain that the oil will go to 80 plus. There could well be a situation it trends at 74 or 72, in which case it gives some wriggle room. So I think all those 8 points that you pointed out are sort of the universe of issues that can crop up, and in that context, if many or some of it were to materialize, the inflation could be in the zone of around 5%, and I think to deal with that is where this rate hike has been brought in, is I would say, and that's why I upfront said that probably in the calendar 18, this may be the only rate hike, and sort of there's one left between now and end of the year, which is the October one, and I think that this may be a precursor of all that is happening in calendar 18.
Fair point indeed. So calendar 18, this is perhaps the last rate hike according to Mr. Shyam Srinivasan. But Mr. Srinivasan, I must ask you the question on transmission. And you know, panelists here have said that when RBI cuts rate, the transmission expected is almost immediate. But when it hikes rates, you've got Deputy Governor Veeralacharya come on record to say that, you know, it always happens with a lag, and he's kind of justified this. By when do we expect the transmission to happen, and what sort of an impact do you imagine this is going to have, sir?
See, there are 2 points to this, Supriya. One is, if you look at over the last, say, 6 months, the trend in deposit rates, which was sort of going down, seems to have reversed. Now 1-year term rates are close to 7 or thereabouts, and the MCLR of most banks are around 9. So that spread of about 200 basis points is something that is there. Competitively, you saw one of the largest banks take one of their longer tenors rates up, and I think that's indicative of the way the calendar rest of the year will play out. I think the liquidity situation may also change. So as a consequence, deposit rates may go up in the 1 year and maybe buckets of 1 year and a little the higher buckets. If that were to happen, the MCLR, as you know, is formulaic. So in the most banks, or all banks actually, once a month review in their ALCO their MCLR, led by the formula of how cost of funds are playing through. So I would think that in the Q2, that one that we are sitting in, and definitely early part of Q3, you would see, if deposit rates goes up, MCLR going up. The rate of increase would vary. It could, I would think it probably 10 basis points at one stroke is what happens, because the impact in the formula plays through like. If there are no rate increases in the calendar 18, as I mentioned, I would think between now and year end, the MCLR may go up 20 basis points.
So you expect the liquidity to be moving into a negative zone as we enter the festive period between September and October?
It does suggest, it does seem like, even the script in the RBI's policy seems to point out in maybe this case for OMO. So yes, there may be some degree of liquidity deficit I expect in the months ahead. Even if you take the recent weeks, on occasions that it has been sort of deficit situations, I would think yes, there is likelihood of a liquidity deficit going into the festive season, and which may again result in rate hike in deposit rates.
Quick questions. Fair point. Mr. Srinivasan, 2 quick questions before I go back to my panel and let them go as well. There obviously was no explicit discussion on the currency for obvious reasons, but is this rate hike also, you know, aimed at defending the depreciating rupee? And do you believe it's going to be successful in doing that?
My view on that, I don't have much of a comment. I just believe that the rupee impact is not just linked only to the rate hike. There are too many variables, and I would believe that the rupee consequence has more variables, and this by itself may not answer the question. But beyond that, I don't have a very studied view to offer.
All right, on that note, Mr. Srinivasan, thank you very much for being with us right here on ET Now to share your views on today's policy action, and of course the transmission that's going to happen with a lag. Let me take this across for a quick closing comment to Maithili Bhusnurmat, our consulting editor, and we of course will then close the show. And Maithili, the big question is that what are the cues that are now going to determine October policy meet? I mean, of course oil will continue to be one such factor, and I'm presuming so will be the full extent of MSP and all of that. But in terms of global cues, and you know, they did not discuss export impact explicitly, but I'm presuming global trade wars, global growth, Fed action will be some of those factors. What are the cues that you expect will determine what the MPC does in October?
Well, if you're talking about global cues, Supriya, I would expect the Fed rate hike, which will come in on the 25th or 26th of September. 26th of September, I expect. Also, the US economy has done very well. So, one will have to watch out for what is the Fed's FOMC statement following that rate hike. What is the expectation? Remember, Trump had said that he's not thrilled with the FOMC's action with the last hike. I wonder what he'll say this time in September when the Fed hikes again. So, that is one thing to watch out for. Another thing that's very important from our perspective is how serious Trump is about not giving any exemption to us for import of oil from Iran. Remember, that also kicks in by November, and Trump has said that we have to reduce our imports from Iran to zero and no exemptions whatsoever. So, that's going to be very, very important for us. Apart from that, I think there is an expectation that the Bank of England might also hike rates. So, overall, we'll have to see what are the external factors, how serious is the trade war, how much is that going to impact our exports performance and of course growth, and what of course is the impact of FIIs in particular fleeing the shores of India, and the rupee, what happens to the rupee, how much does it depreciate further? Are we happy to see that depreciate, or will we worry about what it does to inflation?
Ashish Vaidya, come in and add on pointers that one will perhaps see impacting the policy in October, between the 3rd and the 5th of October, when the MPC does meet. Today was a split decision, by the way. It was 5:1. Dr. Dholakia wanted a pause and everybody else wanted a hike. What do you believe will be the factors that will determine policy then? What are the factors that one needs to watch out for? I mean, the obvious ones, of course, are the ones that I highlighted, some that Maithili added, but any more that come to your mind?
No, I think so. Importantly, yes, the Fed and the Fed statement, which Maithili anyway already pointed out. But I think importantly, how exactly oil is going to behave. I think that has a direct bearing on the India's external account. So that's going to be one important factor. Also, how exactly the inflation has behaved over the next over the next 2 months. So I think that's going to broadly that's also going to broadly impact it. I think importantly. Liquidity also will be a driving factor to my mind. At least that's what the central bank should be looking at. And as some of your panelists already pointed out, clearly liquidity is looking like on a deficit mode, going ahead, because festival season withdrawals will start to come in, and you have an election. So I think that's going to be one another factor which RBI should be considering, and we'll have to see how much they are determined to keep the liquidity on which side, whether it's neutral, whether it's they start moving towards the deficit. I think that's going to be a key. That's going to really come out from the OMO, the kind of OMO they are willing to do, the kind of bonds they pick up in the OMO, whether they do long bonds, whether they do short bonds for giving sustainable liquidity or not sustainable liquidity. So those kind of things I think generally should be watched for, in addition to by those things, in fact, via liquidity also, RBI will be probably sending some sort of signals. So I think that's also an important thing to be watched for.
Fair point. Yeah, that's true. You don't just need a monetary policy to send a signal. You could be sending signals with how you manage liquidity. Are we going to move back into that negative deficit zone? But thank you very much, each one of you, for being with us on this very special edition as we discuss and analyze the fine print of the monetary policy. Second consecutive hike by the RBI, one that has come was one in June, the second in August. The stance continues to be neutral. Indian economy really bracing up for risks that exist to inflation, but the RBI has very categorically outlined both the downside and the upside to all of those factors. Thanks very much for being with us.